And many exchanges try to forbid death spiral finance structure. But I lost out. So be mindful. If you cannot understand how they make their money, that's a huge red flag.
You've just jumped into our masterclass about bad investments. Welcome. We have our business lawyer, Kat, that's going to explain the death spiral finance for us. So get ready, because you do not want to miss this.
Yeah, and our what we can give you is the hardcore facts,
Yes.
the legal basis. When you know what to look for, you will, I'm going to say quite easily, this is not legal advice, it's not financial advice, it's knowledge sharing. But you will be able to assess for yourself. Because this is knowledge that you might not hear from the financial gurus. So
This episode is powered by Key Solutions. We're so happy to be here.
So that's why we're sharing it. And today we're going to share something really scary, right?
Yes.
The death
Spiral finance.
Yeah. So what is it? Firstly, we're talking about a publicly traded company. So if you have shares in stocks in an exchange, this could happen to that company. If it does, sell fast. If you're approaching a company and you can see that they have this kind of financial structure, sell fast.
Really
That's just me, personal opinion, not advice. So, example. We have Optimistic Company LLC. Today they have a price per share of $10, but they are struggling. They need new finance. Really, really struggling and really hopeful. They think that if they get their new patent, everything will just take off. So it's just a little dip in the road. But they've been trying and haven't found anybody grabbing sufficient amounts, right?
So what do they do in this situation?
They are approached by a lender that says that they can issue a convertible loan of $10 million US. Nothing funny about that, right? And the terms and conditions of this loan is that they want a discount. Not shocking that either. But they want a discount that's floating. So they want a 20% discount of the current market share at any point in time. And they can decide when and how much to convert. So the lender, that's called a Mr. Greedy LLC.
Yeah, he's back.
He's back. This is his financial lending distressed debt institute. So Mr. Greedy can decide when to convert, and always knowing that he will get a 20% discount of the current stock market price. And then you calculate that on the volume-weighted average of 2 days prior to them calling on the conversion, or 10 days or 5 days, depending on the terms. And he even demands a ceiling. So he says, and never shall the conversion price be higher than 12, for instance. That's even worse for the company, right? Because then the price cannot go up as much, but it can always go down. So the worst case is they even have a ceiling. And in the best cases, the company can negotiate a floor. Like, no, you cannot convert to lower than, say, 5. But in this case, we have no floor, which is typical. Yep. And sometimes they even get warrants and other things, but we can get back to that. So what happens? Number one, they have issued a loan to Optimistic Company LLC. They got the $10 million US, and now they want to convert $2 million. So remember, this is a rather small company, so that the loan size is sufficient to have a sufficient impact on the overall market value of the shares. Because if it was tiny fraction, it wouldn't make a difference. Like if you were to issue a discounted new share issue to some employees or something, then this would not happen. The death spiral would not happen. But in this case, so they want to convert $2 million US.
Yep.
And then we look, what was the volume weighted average? We have a price of 10. You just write price per share at 10. And they get their price with the discount is 20% discount of 10, then we have 8. So now what happens in the market? Because they are not long-term owners. They want out. So typically they will turn around and flip to make a quick profit. And they can even sell short, and we'll get back to that also. But then what typically happens in the market is that, number one, we have more shares outstanding, which means supply and demand, more supply, that leads to the price typically dropping. And we also have the conversion taking place at $8, right? So they just want to sell their shares at anywhere between 10 and 8. So typically, the stock market, the price will drop so that the price per share will afterwards be 8. Suddenly, the price drops. Okay, then we have step 2. Now, they want to convert another $2 million US. Okay, and then what was the price per share this time? It was 8. And what is then the conversion price? If we have 8, then we have a discount of 20%.
That's 6.4.
Perfect. So as you can see, the spiral has begun.
This is
So
scary.
now, So now suddenly, just because of the action of this lender, we went from a price of 10 to a market price of 8 to a market price of 6.4. And I don't know if should we flip side and do one more just to see step number 3?
We do like this.
Yeah. Now, again, they want to convert another 2 million. Because remember, as long as they have the 20% discount, the ratio, if they sell fast, they will make a profit. And they can work to push the stock price down. And the price per share, the market price this time was 6.4. Perfect. And then we want a 20% discount on that.
And that is 5.12.
As you can tell, it's the spiral. I mean,
Yes.
we're already at 50% of 10.
Yes.
Right?
And it happens very fast.
It's very fast and outside of anybody else's control. So you, as the current shareholders, will get completely diluted based on the actions of this lender having such advantage in their terms and conditions. So that's why we're saying, and many exchanges try to forbid death spiral finance structures, but they are really hard to catch because they can look a bit different. You don't even have to have the exact same terms. It can be contractual, you can use warrants. There are different ways to kind of make it work.
Yes, but what I can see now, there's no return.
No.
It feels like it.
No
because
return.
now we're down to the halfway down the spiral.
Spiral down. And what's even worse is that this Mr. Greedy, as we're calling this lender, he has also gone short. Gone short means he's betting that the stock price will go down, which means that he borrows shares and he sells them and then he buys them. So let's say that here in the beginning, let's say he goes short at 10. He borrows a share at 10, right? Sells it at 10, and then he knows. I mean, he can even convert with a 20% discount. So he converts at 8 and gives that back. The borrowed share, he gives it back. He already sold it and makes a profit of 2.
Wow.
So he can work in many ways to actively drive down the share price while making sure that he and only he profits from it. Oof.
So what I can hear, I don't understand why people use this strategy.
No, and that's why the exchanges, they want to prohibit it because it's so horrible for you other investors. And if you ever see it in any company you're looking at, they will be typically be small to mid cap, not the big size companies because they're not that desperate. But what you see also in the research is that many of the companies that accept this kind of finance, they're really optimistic. They think that if I only get this patent, if I only get through this dip, I will make it. I just need quick finance and then I will get out. So learn to recognize these structures because they are horrible, they suck, get out.
Get out.
Not financial advice, our opinion.
Yes, our opinion. So, I mean, this is really good.
So it's a death spiral finance.
Yes, and now you know about the death spiral finance. It's just as it sounds. So, as we said, watch out for this.
Bad investment.
Bad investment. And this was one of our episodes in the masterclass about bad investments. And if you want to stay ahead of the game, you have to subscribe and like and share our channel to your business partner or network.
And let us know if there's any good or bad investments or you disagree or have any questions. We would love to hear.
We would love
in
to hear
particular
that.
about the bad investments.
Yes, and if you have experience, I mean, please share it, as Kat was saying. So thanks for today. And I just want to say that this episode is powered by Key Solutions. We're so happy to be here. Thank you. You just jumped into this masterclass about bad investments. Welcome. In this episode, we're going to go through something called margin trading. We're going to share things that you might not hear everywhere, and Kat is here with us today and explain it for us.
Hey.
So we're going to go through both calculation and also when margin trading can go deep down to the ground. Indeed. And we're also powered by Key Solutions today, which we are very happy about. Remember, this is not legal advice, it's knowledge sharing. We have Kat, our business lawyer, here to explain and go through different strategies and outcomes when it comes to bad investments. So today we're going to start.
Yeah, and it's definitely not financial advice either.
No.
What we're going to do is we're going to give you the basics, what you need to understand, how it works, and we're going to look at what we can help you the best with it, which is understanding the fundamentals of kicking off a margin account and trading on margin. Not everybody talks about this, so you might even be surprised what we're going to tell you, really what you're getting yourself into. So we'll start off with the example.
So that's really good, to have the legal aspects of it.
Yeah, indeed. That will help you assess whether this is really a bad investment for you or not.
So let's start.
Okay, so we're going to start with just what is trading on margin.
Yep.
And to know that, we'll start with just looking at regular trading, a cash account. That's typical. You take your hard-earned money and invest it, right?
Yep.
So what you stand to lose or gain will be based on what you invest, right? So let's jump into an example.
Yes.
Let's say that you have $100,000 to invest, and you invested at a stock that you really like, and we have a price per share of 100 of the stock you're interested in. And let's say it's a share movement of 30% up, and then we have a new price per share of 130. And then what will the result be? Well, you invested at 100 and you can sell it at 130, and the total amount was 100,000. So result will be plus 30,000, right? A nice profit of 30%.
Great.
And then we can jump down and say, just to give one more example, let's say that the stock price goes up to 200, same prior.
Same.
So, yeah, and here you have an increase of 100%. So this time you invested at 100. You sell at 200, so the result will be you made 100,000. Nice. Really nice. And that's in percent, we're talking about 100%. Yeah.
Plus.
And just to make it holistic, we'll of course look at the downside.
Yes. Now, you listen up.
So same here, but this time the value will instead drop. And let's say it drops with 50%.
So minus 50.
Yeah. And then you have a new share price trading at 50.
Yes.
Okay, so we invested at 100. We sell it at 50. That means we have a negative result. You lost 50. So minus 50%.
Minus 50%.
That was a bad day, right?
It was a bad day at work.
Cut your losses. And a new one, same. And this time, let's say that the stock price drops to 25. So minus 75. And we're going to show you with the margin why it's so important to see the difference. And then you made a loss of 75,000, right? Invested and sold. Minus 75. Yeah. Now, to the magic of margin trading.
Yes.
This was the regular. You put in your hard-earned 100,000. Well, margin trading, as a lawyer, I would say it's a loan. And the typical, and we're going to base this example on the US rules and regulation, but that's very general how it works. Then you typically have a 2-for-1, which means that if you put in 100, they will lend you 100.
Okay.
So now, if you want to trade a margin full out, instead of investing, you still only have 100,000. But instead of investing those 100,000, you will be investing 200,000. 100 of yours and 100 of the brokerage firm. Same price per share. We're going to stick to the 10, 100. Same value of development, plus 30. Same new price per share, of course. Otherwise, we would be surprised.
130.
Yeah. But then, now, last time you invested 100, right? This time you invested 200, which means that the value increased from 200, 30% up. That's 260, right?
Yeah.
So the result is plus 60,000. Because you invested at 200 and you sell at 260, right? So, value development, 60% up.
So far, so good.
Yeah. And what's really interesting here is the fact that you invested the exact same amount, the exact same share price, the exact same development of the price, of the stock price, but the result was double.
Yeah.
You made double the amount just because you used margin. You made the double the profit.
Yeah.
So leverage finance can be quite good, right?
Yeah.
Let's go with another one also just to make it clear. We know the calculation. So here we have same, still. You only have 100, but you can invest 200 because you borrow. The value development plus 100. So the new stock price is 200. This time you invested at 200. You can sell at twice. So you sell at 400. That means a profit of 200. A value growth of plus 200. So leverage finance in itself can work magic for you if you know how to make it work or you're really lucky, right?
Yes, of course. It looks really good.
I mean, wouldn't you be tempted?
I would be.
Yeah, exactly.
But
But let's go to the last two examples. Let's say that's the same, but this time the value drops 50%.
so it's here.
Minus 50. Then the new share price will be 50. But now then, you invested 200,000, which means that instead of selling half, which we had here at 50, and you made 50, you will be selling 100,000, which means that you make a loss of 100,000. That's your total investment.
Yes, I lost it all.
Yeah, you lost it all. Right? So it's a loss of 100%.
Well,
So just because you used margin, instead of having 50 left, you lost everything.
yeah, it sounds crazy.
And it will get worse. Because when you only use your own money, losing everything, losing 100% is the maximum you can lose, right?
Yeah.
And that will suck enough.
Yeah, it will.
Yeah, exactly. You lost 100,000, my God. But let's look at the last example using the margin. So same, 200,000, borrowing 100, your own 100. Price per share 100. The value drops with 75%. The new share price is 25. But now then,
What happens now?
yeah, because this time you will lose twice as much. So the loss will be 150, right? Because you bought at 100 and you sell at 25, and the investment price, total investment amount was 200. So you will have lost 150,000. That's minus 150 in result. So you will have lost more than you put in. You will end up in debt, so to speak.
Yes, because if the other 100,000 you need to pay back.
Yeah, so you only have coverage for 50. You can get back 50, right? Because you have 50 you got from selling the shares, and then another 50.
Oh, so you need to pay back the loss, and then you still have some more to
so you
pay.
lost more than you invested. So that's why it's super dangerous to use margin account without knowing what you're getting yourself into. Because just investing regularly, risking to lose all of your money is sufficient for most people, right? It's gutsy to take what you have and put it in more publicly trading, more active trading, right? So here is the risk, and it gets worse. Because on top of this, we have something called a margin call.
And what is that?
That is that the brokerage firm won't let you have any type of development on your account, any type of share development, and just sit quiet. You need, when you start investing, I said a 2-for-1. That means that they give you as much as you put in, right? But once you have your account, they will have a maintenance requirement.
Okay, what do you
Which
mean
is,
by...
according to FINRA, which is the self-regulatory body in the US, it's at least 25%, which means that your equity stake, part of your portfolio, your account, needs to be at least 25%. And the brokerage firm where you have your account might have a higher requirement. And if your equity stake drops below, so that your equity stake is less than that 25% of the total, then you will get a margin call.
Oh.
And that means that you either have to put in cash or other securities that they deem to be secure enough as collateral for your investment, or they can force sell your position.
Oh, that sounds so dramatic.
So the money's gone. And you cannot even decide when it happens. They don't even need to call you prior. You might not even get that margin call. And they can choose which, if you have different shares or different securities, they can decide what to sell without even talking to you first.
So when you say this is a big
This
risk...
is the legal advice I want to give you. Know what you're getting yourself into. Read the margin account agreement before. And I'm a lawyer and I don't always read all of the agreements.
No.
I can go to the bank or somewhere and just click OK or just sign to get through, or go to the doctor and just OK, I sign a waiver. But this time, read.
Yeah.
This is worth it. This is so heavy.
Because this is the picture you get from the beginning, and then it just...
Yeah, it can ruin your life.
Can ruin your life, yeah.
So we're going to end this with reading 6 must-knows that FINRA actually demands that every broker gives you on a one-pager before you open an account. And you need to hear them, you need to know them before you make the decision. Because as so often, it's when you're in trouble and you get that margin call, you start to scramble with your papers. Like, can they do this for real? Can they sell without letting me know? Why are they selling that asset? I want them to sell that asset, or I want an extension. No, you're not allowed. So let us together now just review the must-knows. 6.
6. Let's start.
Yeah. So, number 1, you can lose more funds than you deposit in a margin account. A decline in the value of securities that are purchased on margin may require you to provide additional funds to the firm that has made a loan to avoid the forced sale of those securities or other securities or assets in your account. Number 2, the firm can force the sale of securities or other assets in your account. If the equity in your account falls below the maintenance margin requirements or the firm's higher house requirements, the firm can sell the securities or other assets in any of your accounts held at the firm to cover the margin deficiency. You also will be responsible for any shortfall in the account after such a sale. Number 3, the firm can sell your securities or other assets without even contacting you. That's a bad one.
That's a really bad one.
Yeah. Some investors mistakenly believe that the firm must contact them for a margin call to be valid, and that the firm cannot liquidate securities or other assets in their account to meet the call unless the firm has contacted them first. And that is not the case. Most firms will attempt to notify you about the margin call, but they are not required to do so. However, even if a firm has contacted you and provided a specific date by which you can meet that margin call, the firm can still take necessary steps to protect its financial interest, including immediately selling the securities without notifying you. So know that. This is the legal nitty-gritty, and we're reading it from FINRA's disclosure requirements, so we're not making this shit up.
No, we're not making this shit up.
Let's see, we're number 4, almost through. Hold your breath. Number 4, you are not entitled to choose which securities or other assets in your account that are to be liquidated or sold to meet the margin call. Because the securities or collateral for the margin loan, the firm has the right to decide which securities to sell in order to protect its interests. Remember, I'm always talking about protecting its interests, not yours. Number 5, the firm can increase its house margin, maintenance margins, without any prior notice at any point in time. These changes in the firm policy can hence take effect immediately and may result in the issuance of maintenance margins called. Because you might thought that you were safe, and then suddenly you're not. Your failure to satisfy such a call may cause you to end up in a situation where they force sell your securities. So you didn't even see it coming. And number 6, you are not entitled to extension of time on a margin call. While an extension of time to meet margin requirements may be available to customers under certain conditions, a customer does not have the right to such extension. FINRA, margin disclosure statement. Must know. So we're in the US right now, but trust me, most likely you're not better off anywhere else. So do check out, do discuss, do make sure that you understand what it means to open a margin account and the rights they have to force sell, how it works if you get a margin call, what's the margin maintenance requirement. Do you have other funds? Are you loaded? Can you put in other securities so that you don't end up having to force sell? Fantastic. Then you're good to go. This might be a small portion of your great portfolio, right?
Yeah.
But other than that, be mindful.
Yes, and I understand you have to write an agreement before you start, right?
Absolutely.
So read it through carefully.
Do read it through. Make sure you understand not only the severe consequences of using margin, but also the margin call. So you don't think that I can hold up, I'm gutsy, I'm okay. This is just a temporary dip in the market because of COVID or something. Well, you might still end up in a margin call. And then they decide to sell for you.
So be prepared.
Then it's gone.
Thank you so much. Is there anything else we need to know about this?
I think this is it.
Thank
From
you.
the legal perspective.
That's so good. So now you have another one big tool in your toolbox that you know about, and it's this.
Yeah.
The margin trading.
If you're really good or you have some ring fencing, you're working through a fund, etc. But do know what you're getting yourself into legally.
Thank you.
It's a loan.
Yeah.
Margin might sound sexier, but it's a loan.
Oh,
You need to
remember
pay.
that.
No risk sharing. They're not sharing your risk. They will need to get paid back.
Thank you so much. And if you want to stay ahead of the game and don't get left behind, like and subscribe to our channel because we're going to keep sharing some really good knowledge that you will use. Thank you for today. And we're back, and you've just jumped into the masterclass about bad investment. And today we are tackling the most nerve-wracking things in the investment world, which is called the short selling. This is not for the faint-hearted, so please hold on because Kat's going to explain short selling to us today. Welcome.
Thank you.
Our business lawyer. So
Hey.
this is really good to have the legal aspects, and we're going to also describe what's going to happen when the short selling is on.
Yeah. So we're going to make it simple. No legal advice, no financial advice. We're going to give you tools to understanding what's really going on. So you yourself, you're empowered to realize if this is a really bad, risky investment for you or if it's something you want to dig into.
Yes. So this is a way to keep yourself educated and follow and like and subscribe us because we're going to share this valuable knowledge.
Yeah.
Which you're going to use.
And you're going to understand why this is so risky. So really know what you're getting yourself into.
Yes. Let's start.
Yeah, let's start. So, basic. Go long. That is the typical. you take your hard-earned money and you invest it into the stock market. Go long. So we're using a simple example here. A share price of 100. You have 100,000 to invest, so you buy 1,000 shares. So let's say we have a price development of, should we say plus 25?
Yes.
Plus 25%.
Developing of the shares.
Yeah.
So, yeah.
New share price, or we can take the total account value. If the new share price is then 125, we have a share price value of a total value of our investment of 120. So we made a profit of 25,000.
Really good.
Go long.
So far.
You buy first and you sell. And worst case in this would be that the market plummets to zero. That's the absolute worst case that can happen here. You drop 100%. So what will then be the value?
0.
And what will be the result?
A minus.
You lost it all, right?
Yes.
Not good.
But you only lost your own money.
Exactly. This is the bottom line. And we're going to get, you will see why we're stressing this. Because when you short sell, it can get worse, much worse.
Yes.
But here's the limit to the loss here, your total investment. So there you have it. Go long. Investing in the stock market, you buy first and then you sell, hopefully at a higher price.
But in this case then?
Yeah. So short selling is the other way around. Because in this case, you can only profit if the value goes up, right? But what if you want to invest betting on the market going down? How can you do that? Yeah. So what you do is you flip it. So you start by borrowing a share. So we start by borrowing 100 shares.
100 shares.
Because we know that we will drop, the share price will drop. So you borrow it at 100, total of 100,000 then. And then you can write the total, I believe.
100,000.
Yeah.
So, yes. And it's US dollars, let's say that to be.
Yeah. And then you sell for that amount. So you sell at the current stock price. So you sell at 100,000. You borrow them and then you sell them. Yep.
Yep.
And then you need to pay interest because you borrowed something. Nobody will give it to you for free. So that's also heads up that will cost you. And then let's say you're right. So the stock market drops by 10%. And then the new share price is 90. So you borrowed at 100 and you sold at 100. 100,000, 100,000. Now the new share price is 90. And you need to give the borrowed shares back. So you buy for 90,000. What's the result?
The result is
A profit of 10.
profit of 10%.
You just made a profit of 10,000 US dollars. Betting on the market going down.
Yeah.
Let's take another example. The same, you can just...
I do like this.
Yeah, perfect.
And then...
The same again. Because you borrow at the current market price and you sell. Borrow and sell. Then somebody wants it back. So what should we say the development?
Minus
25?
25.
Yeah.
Can be good. So now it dropped 25%.
Yeah. So the new share price is 75.
Yep.
That means that you're buying the shares that you need to give back for 75,000. This time, you made a profit of the market dropping by 25.
No, 25. I'm sorry.
Because you made a profit in cash of 25,000.
Yeah.
And a new example.
Yeah.
What if you are wrong?
Yes.
What if the value of the market goes up? So let's say it goes up with 10. New share price 110. You need to buy for 110,000 because you cannot give them back if you don't buy them back, right?
No.
So that means you make a loss
Of 10%.
Yep.
So
So now, because the market went up, you are betting on it going down, you have to buy the shares for a higher price that you borrowed and sold them for.
Oh, so now you made a loss.
Yeah. And we can look at the 25% also quickly.
Yes.
So, guess what? 25%. That means that the new share price is 125.
Yes.
So you need to buy them back sourly for 125,000, making a loss of 25.
This looks crazy.
This is bad, but it can get worse because the problem here is, let's go for another example where we're going to explain why this is unlimited risk.
Oh.
We talked about the going long, that the risk stops at your investment. If it's leveraged finance, also the part you have loaned, of course, you will need to pay back. But in this case, we have no control how much the market can go up. I mean, in theory, it can go up unlimited, right?
Yeah.
Yeah. So that means that let's say that it goes up with 600%. Then the new share price is 700. That means that you have to buy back the shares at 700,000. So your loss is 600%.
Oh.
And we're talking about having to pay up 600,000 to buy back the shares.
Jeez. Oh, this is crazy.
So that's why be mindful when you short sell that you cannot control. And if you ever heard of short squeeze, this is it. When a stock is heavily shorted and it suddenly has a peak and more short sellers need to close their positions, so it's more and more buy pressure on the market. So it just, like, you heard of GameStop or Volkswagen?
Yes.
Yeah.
Everything just go up.
Yeah. So many people went bankrupt and many hedge funds went bankrupt during that short squeeze. So be mindful, be careful, know what you're getting yourself into. As a lawyer, I'm saying, whoa, terms and conditions, you're borrowing, selling, and then you don't know what you're buying it back for. That's risky. So make sure you have a strict strategy if you're getting yourself into this.
So you say it can be unlimited loss.
Yeah. And if you get a margin call that your broker is saying that you don't have enough equity position left that you're in your account, they can even close your position for you. So you cannot even control it happening. Wow.
So this is why you need to know what this is and the risks of it.
Indeed.
Thank you so much.
Thank you.
And now you have this in your toolbox. Really good to know how to not to make a bad investment and lose all of your money and even more than that.
Knowledge is money.
Knowledge is money. So keep educating yourself on business law and these kind of strategies because it's really helpful.
Powered by?
And this episode is powered by Key Solutions.
And if you want to learn more about the legal, the deep, we're here for you. Like and subscribe.
Like and subscribe, because if you want to stay ahead of the game, you need to know what's happening in the world, and especially in the business.
Yeah.
So thank you so much for today, and thanks to our business lawyer, Kat.
Thank you.
Thank you. Until next time. You've just jumped into our masterclass about bad investments. And sometimes you might think that you are safe until you are not. Today we're going to talk about something called the margin call, which is a devastating thing that could happen to you on the market. And to explain that to us, we had Kat, our business lawyer, here.
Hello.
Welcome.
Tackar.
Today we're going to talk about the margin call.
And margin maintenance.
And margin maintenance, which we're also going to show you how to calculate it.
Yeah, good to know.
This episode is powered by Key Solutions. We're so happy to be here. So this is for you who is curious about investment but do not want to make a bad investment and go bankrupt. So that's why we are here today.
Could be a good one.
Could be a good one also.
And we did another show showing how leverage finance and trading on margin works.
Yes.
With the big risks, but also the upside.
Yeah.
So you can watch that if you want the basic.
Yes. We're going to show some upside, but we're also going to show you what can happen.
Yeah. Today is mostly about the downside.
The downside.
Yeah. No, but margin account, you trade using a loan. So a cash account, you use your own money.
Yeah.
You can win and you can lose, right?
Exactly.
Lose what you put in. if you use a margin account, you take a loan. So we talked about the 2-for-1, which is typical, that if you put in 100 of your own hard-earned money, then you get the equivalent, the same amount as a loan, 100.
So then you have the double 200 to invest.
Yeah, which means that even if you only have 100, with the same development on the market, stock market, you can make twice the profit because you leverage it through the loan. And you can make twice the loss. So bigger risk.
Yeah.
But on top of that, if the development of the market goes down, we can also end up in a situation where your broker, where you have your account, makes a margin call, like the famous movie. Yeah. And the reason is that they have a requirement that the equity part of the account, they have a requirement that the equity part of your account must be at least 35% ongoingly. So the value cannot drop in infinity because they will pull the plug because they want to protect their investment.
Of course.
And then they can call you and make that margin call. But they can also just force sell your shares.
They do not ask nicely.
No, they don't even have to ask.
Oh.
They do not even have to ask which shares, if you have more than one type of holding in your company, they want to sell. They can just go and do. So if you drop down the margin maintenance ratio that your broker has in your agreement, you have to look at that. The FINRA, the US regulation, says that it must be at least 25%, but typically it will be higher. And it can also be calculated in different ways. It can look at what specific stock you invested in, or it can be on your total portfolio. So you need to know, and also know that they can change it ongoingly. They might be at 35 and you feel like you're safe, and then they might turn it up to 45.
Okay.
And suddenly they can force sell your shares if the value of your equity stake goes down.
So you really need to be aware of this percentage.
Yeah. Incredible.
Good to know.
Yeah. Because if they do sell close to your position, then any loss will be realized. You cannot salvage it. But if you get the margin call, you can also put in other equity as collateral, which means that you raise the equity stake of your account, or you can put in cash to cover them so that they will not force sell, so they will not close your position.
Okay, so there is a solution, but...
Yeah, to raise your equity.
But then you need to have some backup for that.
Yeah, exactly, if you can. Okay, so how do we calculate? Because you need to understand if you're safe or not. How much movement in the stock can you take before you end up falling below your margin maintenance ratio?
Exactly. How do we know?
How do we know? So what we do is that we will look at the total amount of your account. And in this case, it's 200, right?
Yeah.
Total value. We will start at the beginning. So account value minus the loan, because the loan part will never move. They're not risk sharing with you. So that will be the same. And loan, here we said the margin amount, 100. And then we'll divide that with the account value. And we get the percentage here. So,
okay.
Yeah. So in this case, if we start from the beginning, the account value will be 200.
Yeah.
Minus the loan, 100.
Yeah.
And then we divided into the with the account value again, which was 200.
200, exactly.
So then we get 50. So then your equity stake is 50%, right? 100 of 200. And that's also the 2-for-1. That's where we start off. And let's go for 2 examples when the stock price moves after we initiated the margin.
Yes,
trading.
so now we're going to show you some examples.
Yeah.
So let's start. So if we start with a share cost at 130.
So it increased from 100 to 130.
So that's...
Meaning that the movement is 30%. And given that we use margin, our result will be up 60.
So we 60,000.
And the margin account value will hence be 260.
Exactly. So that's a fast move.
Yeah. And I mean, depending on the size of the stock, what you're trading in, it can be very volatile.
So this is just because the stock went up 30%?
Yeah.
Okay.
And since it's leverage finance, if it was not leverage finance, you had only invested your own 100, then the result would have been 30 plus and 130 in total.
Ah.
But in this case, you doubled your profit thanks to leverage finance.
Yeah.
But then we look at the margin ratio. Then we take the new account value, which is 260, minus the loan, still 100, and divide it with the total account value. And then we have
62%.
62%. So that's good. We're safe. We're no problem. Margin call?
No,
No.
because we are not below the 35%.
Exactly.
Good.
And then let's take a negative example.
Yes, so let's say that the stock is worth 75 only then though.
Yeah, so it dropped with
25%.
with 25.
Yes.
So then the result?
That would be minus 50,000.
Yeah. Again, if you had not used the margin, only your own 100 cash, you would be minus 25,000.
Exactly.
So we doubled the loss thanks to us using leverage finance, the loan.
Yes.
Yeah. So the account value would be 150 now.
Yes.
And then the question comes. So then we take the new lower account value, 150, minus the loan. Again, that will not be moving because they will not risk share. Always 100. And then we divide it with 150. And what do we get?
We get 33%.
Now then.
What happened
Will we
now?
get a margin call?
Yes, because now we reached below 35%. No.
No.
So this is where the shit is going down.
Yeah. So then the broker has a right to force sell your shares, close your position, or he can call you and ask you to either close the position yourself, pay back the loan, or cover the remaining 2% with cash or other equity that they can use as collateral. That's the margin call.
Okay. So when this happens, if the shares drops even more, can it get worse?
Absolutely. Should we go with another example? Say that the share price drops to 25.
25.
Yeah. And then we have a share price movement of 75%. Result.
Then it's
150.
150.
Again, doubling.
So this can just spiral down.
Yeah. I think we lost a 0.
Oh, here it is.
And then the account value?
It's
50.
Yes.
No, it's 50. Perfect. And then what do we have in the margin ratio? Account value, 50, minus the loan, 100, divided by 50. And then we have a margin of?
Minus 100%.
Yeah.
So the catastrophe has arrived.
Yes.
This is dramatic.
Yeah.
And this is why it could be a bad investment.
Indeed. And also when you get the margin call, if you need to close your positions, you might even have been short selling. We'll have a specific episode on that.
Yes, we will.
Yeah. Then it also might be the case that it will be a short squeeze, meaning that many short sellers of the same stock need to sell at the same time while the stock price is rising, which means that your loss will be higher and higher, and that development can go really fast. So it can be very dangerous because you need to close your position, right? So you need to buy while the market is climbing. And you might not even know how many shares, the float, as it's called, are available for you to buy. Because the fewer shares out to buy, the more buyers, the higher the price climbs quickly. So you might be in a real squeeze. And then if you get a margin call, you might be forced to sell, making an incredible profit. Loss.
An incredible loss.
Loss. Short selling, unlimited loss.
It is?
Yeah.
Yep.
Yeah.
So, I mean, this is what can happen if you decided to invest and do not know what you're getting yourself into.
Yeah. And also, me as a lawyer, I don't read all of the agreements I sign. Going to a bank or something else like formalities or opening an account, yeah, sure. But if you open a margin account, make sure you know when they can make that margin call, what happens, what rights do you have, or rather, what rights do they have to force sell, liquidate? What is the ratio that you need to maintain? Do you have a plan? Can you put in some other equity from another account to cover so you're not so they don't force sell? Or do you have cash you can put in? Or is it too great a risk exposure for you? So in this case, strong legal recommendation, read the agreement, ask your financial advisor. This is not legal advice, this is not financial advice. This is us helping you, giving you the tools to understand, to make the good investments and stay away from bankruptcy and bad investments, because this really is high risk.
Yes, it is. Thank you so much for explaining this. And now you know how this works. So you know, if you are getting into this, you know exactly what it's about. Remember to ask all the questions before you start.
Yeah. And let us know about your bad investments.
Yes, we'd love to hear that. And if you want to stay ahead of the game, you need to like and subscribe and share our channel, because we're going to keep sharing this valuable knowledge for you that you can use in your everyday business life. Thank you so much for today, and thanks, Kat.
Thank you.
Until next time. Hej då!
Hej då!
Do you have shares in the market and think that you are safe? Well, I think that you have to think one more time, because there is something called the wipeout, and it is exactly what it sounds like. Very dramatic. You can get totally wiped out.
Indeed.
And that's why we have Kat with us here today. She's going to explain and calculate this for us, so we have a good understanding for this.
Yeah, and we're doing this bad investment series because some things, I mean, there are so many investment gurus. We're not even competing with them. But we are legally trained. So there's some things, if you know the setup, the structure, you will be able to identify them and make the call to not make those bad investments, and also know when to sell fast to save your money.
We are powered by the Key Solutions, and we're so happy to be here and collaborate with them. So this is masterclass from the bad investments. So you're going to learn a lot from this, because we do not want you to lose money if you don't have to.
Indeed.
So that's why we're going to talk about the wipeout today.
And it's not
legal advice. This is only knowledge sharing as usual.
Yeah.
Have in mind.
So we have Optimistic Company LLC.
Yes.
So you can just write Optimistic Company. And this company has been struggling, trying to find new finance, struggling with its cash flow, and currently it has number of outstanding shares, you call it NOSH, of 50 million.
Yeah, so we start there.
Yeah, number of outstanding shares in total, 50 million traded at the stock exchange. And the price per share is $10. That's the current state. And it's out there trying to fundraise, and you can also see on its balance sheet that it has a high degree of debt and not enough cash flow to cover that debt. So it's getting desperate, really desperate.
So something has to be done.
Here comes the wipeout.
Yes.
So what it does, it agrees typically with current majority shareholders and lenders or new lenders, shareholders, financiers, that it will issue so many new shares at such a low valuation that the current shareholding will become irrelevant. So if you, Ida, are part of this shareholder collective that today owns 100%, this will wipe you out. So they issue, you can just write issue, they issue 4 billion new shares. That's 4B is enough. Perfect.
That's a lot.
That's a lot. And the price per share will be $1. So that means that there will be 4 billion new shares out in the market. 4 billion. So what then has happened to that old shareholder collective that had 100% of the company prior to this wipeout? Well, let's take a look.
Let's have a look.
So now, after, we can do a after.
Oh, the red pen is coming.
The red pen is out. You can start with the black. And then now, how many shares, NOS, do we have now? Well, we have 4,050,000,000. So 4.05
billion.
B. Yeah, yes, B. Perfect. And most likely, the price per share, given that there are so many new issues out on the market, will have gone to $1. It can be lower even. So $1. So what happened to you?
Well,
The current shareholders, so if you say the old shareholders, perhaps?
the old share, I'm going to write OS.
Old shareholders. They owned 100% of the company. Suddenly, they own 1.2% of the company. Because they only own 50 million divided by 4.05 billion shares.
Mm-hmm.
And the value, your price per share, will have dropped, so you can write minus 90%. So basically, you're wiped out.
Yes. And everything got diluted here.
Exactly. Perfect. And I mean, you might even have bought the shares at $25 per share, even.
Yeah.
Because when you end up here, you probably have seen a downward trend already. So this is a wipeout.
This is a wipe. I mean, is this common to use this strategy?
Well, this is when a company is really, really struggling and gets this like last second chance to survive. But I mean, for any of you current shareholders, it's disaster.
Okay,
It's
but
over.
Are there any benefits with it?
Well, the company might survive because it
Yeah.
gets a new ownership group. They can take over and they get a new financing structure. But you, the old shareholders, you're out.
You're out. Wow. So
Wiped out.
you're totally wiped out. So, I mean, have a look at this. Pause and listen again because this is very important to know because, I mean, there can be dramatic difference.
Yeah.
Dramatic.
Dramatic.
Thank you so much for explaining this to us. And now you know about the wipeout. And if you want to stay ahead of the game, you must like and subscribe to our channel because the business won't wait and you have to be upfront with what's happening.
And we are powered by.
We are powered by the Key Solutions and we're so happy to be here and collaborate with them.
Brilliant. Thank you.
You just jumped into our series about bad investment. And today we are going to talk about something that's been draining investors for years. Actively managed mutual funds. They promise high returns and no risk. But really, is it like that? Let's find out. So what we're going to talk about is what you actually do pay for when you have these kinds of funds. And we're also going to give you examples on 2 different funds and how the difference can be.
Yeah, the must know for you.
The must know. And we have the cat, the business lawyer here to explain it.
Hi.
So you really know how to spot if it's a good or a bad investment.
So mutual funds that are pool of investments from you and I, we pool our money together, professional manager that then goes out and invests for us.
So I have a pro managing the money for me.
Yep. And the benefit, well, there are several. The pro is one in some form. And the other is that you get this buying power. Because if I want to invest every month, I might not be able to get exposure, this diversification that I can get if we all pool our money and then go out to shop, invest together, instead of just me trying to chase some small ticket sizes here and there, right?
Yes.
Yeah. So mutual funds as a core is a brilliant way to invest. I mean, the pooling of capital is a very good form for most people, most of the time. But we have an inherent problem. And I'm going to say that the US investors are better than the Europeans. They have come longer in understanding this. I think a lot is thanks to John Bogle and Vanguard, who's been preaching for years to watch out for high fees. Because we have 2 types of mutual funds. We have the passive and the active. The active, that's what you talked about, the professional management. Somebody sits there and evaluates, does the research, lifts the phone, presses the button, sell, buy, I want that, not that. The passive, that will copy an index. So it won't be an active decision. It won't be, I'm betting on Google today and I want to sell Tesla. It will copy Standard & Poor's 500 or some other index. So it will always intend to mirror that, and the value growth will hence be the same as the overall market. And the overall market tends to go up. So that's good. And the problem with the actively managed is that the research and the data does not, in general, support that they ever outperform the passive ones. That means that they do not do better, but they do charge a higher fee. And it might not sound like much. I mean, imagine that you and I were offered to either go with a passive mutual fund that has a fee of 0.2%. Yeah, 0.2. That's annual, typical. So you get a 0.2.
Yes, thank you.
I want to go with this active. I'm so impressed. They're so enthusiastic. They know what they're doing. So I will go with an active fund that has a fee of 1.7.
It doesn't sound so much.
No, I mean 0.2 or 1.7. Yeah. And I mean, I'm good. I get these professionals watching my money.
That's good.
Yeah. But if we now then say that we have the same development, an annual growth of 7%, because that's reasonable to expect. And then if we invest year one, we will have something called compounded interest on the money, because we have interest on interest each year. And I think Einstein actually said that this is the 8th miracle, because the one who understands it will get the world, and the one who doesn't will be paying for it.
Okay, that was really good.
Yeah.
Yeah.
So let's try. Let's say we put in, how much have we invested?
100,000.
100,000.
Yes.
Yeah. Yearly growth 7%. Fee 1.7. Fee 0.2.
Yes.
So let's see. We can start with me. Let's see. After 10 years, I come knocking at the door, open my account, and I have a look. So active fund after 10 years, my money will have grown. Wow. 165,719. I will have paid fees in total of $23,073.
And that was 10 years.
Yeah. How about you after 10 years?
Let's have a look. So after 10 years, I had a growth of $192,816.
Oh, no.
So
okay.
I had a bit more than you.
Yeah.
And fees total paid is $2,927.
I don't like that.
You don't like that?
No.
Do you see the difference? It's 2,927 and you have 23,073.
And even more importantly, what do we have left in our account?
Yes.
Uh-oh. So we're saving for the long run. We're going for the Miami house in Florida where we retire.
Yes.
So how about after 20 years? Let's start with me with my active fund with that fee of 1.7. After 20 years, I will have $274,629,000. That's okay. And paid approx $61,000 in fees. Ooh.
In 20 years. So year 20 for me is, well, the growth is up to $371,780. So it's a bit more than you.
Yeah.
And total fees paid is $8,571.
Okay, now we're talking.
We're talking a lot of money here.
Yeah. Perhaps I didn't make such a good call anyway.
Well, I'm really proud of mine.
Well, let's see after 40 years. It's time to buy that villa.
Yes. Now we're up for shopping and we're going to buy our house.
Yeah. So I'm about to cash out. And I can cash out $754,209 and paid fees approximately $230,000. But I mean, that's a good saving. I mean, still, I put in 100,000, and I mean, so saving does pay off.
Yeah.
Yeah. How about you?
My savings are up
Ooh.
$1,382,206 US.
Okay.
How about that?
Ouch.
Ouch. And total fees paid is $40,435 US.
That means that because I choose 1.7, a little one. It's
Yes.
only 1%, right? I choose the higher fee of 1.7. I lost $627,997 US.
Wow, that is
Paying for nothing.
crazy. What did you pay for?
Nothing. I lost out because you had it compounded, and I lost out because they dug a hole each year with the fees.
I mean, $627,000 US. That's a life saving.
Yeah, that's crazy.
So I think I managed good.
You did good. I did not do good. So this is what we want to show you, the importance of that silly little 1.7. Because if the active fund outperforms crazily, they can take a higher fee, right? But do know that those small percentages of fees will have an incredible impact. So do be mindful, do be careful. And there's little data showing that the active ones do outperform the passive index funds. So
how should
be
you...
mindful. That's all we want to say. This is not legal advice. This is not financial advice. This is information.
Yeah, you have it black on white. But
That
how
hurt.
should you think, I mean, to find a good passive fund? You need to do a lot of research, I guess.
Well, I would say no. I would say with the passive funds, it can also be ETFs. That's funds that are traded on the stock. The only difference is with the direct mutual fund, you buy and sell units from the fund. With the ETF, you buy and sell secondaries on the stock. But still, look at a passive fund that mimics an index that you know, that you're familiar with, and go with somebody that you trust. I mean, I don't want to give financial advice. I don't want to say anybody, but that's not too complex.
It is not.
No, they're rather stable.
Yes, and it can actually end up you having $600,000 more if you just choose the right fund.
I would be okay with that.
Yeah.
I wouldn't mind.
I think we all agree on that.
Yeah.
Well, thank you so much for clearing
Short and
this
sweet.
up. Yes, clearing this up in such a good way. If you like our content and think that this is valuable, like and subscribe to our channel. We're going to keep sharing this for your community to know this good stuff.
Lovely.
Great.
Hej då!
Hej då! So, you want to make money? That's great. In this episode, we're going to give you the warning signs, what you should watch out for when you're doing your investment. And make sure you're not just handling your money away. And we have Kat, our business lawyer here.
Hi.
And she's going to give us everything we need to know so we just do not hand over our money. This is a part of our bad investment.
Yeah, and we're going to give you the quick and dirty, the checklist, what typically can indicate that this is a warning sign, stay away, bad investment. None of them are yes or no. They're indications, so a checklist.
Yes, and remember, this is not legal advice, it's knowledge sharing for you to get an opportunity to make mindful and decent decision in your life.
Yeah, we're the real deal. So no gurus, no TikTok crazy make-believe.
No, we're going to rip the curtain off. So let's start just right away.
Yeah.
So if you're about to do an investment and someone is, hurry up so you do not miss out.
Yeah.
Is that a warning sign?
Typical warning sign. If somebody tries to stress you into make the decision, take 2 steps back. Hold on. Why? Do you need to do more research? Find out more, reflect, get second opinions. So that's a warning sign.
Yes. But it's risk-free.
No investment is risk-free. No. So if somebody says that, that's not serious. That's an indication that they are not professional.
Yeah, but it's very common though.
High risk, high reward. Low risk, low reward. But no risk, no investment.
Yeah, simple as that. But fee structure secrets.
Is it unclear? Do you not understand how they make their money? Then probably there's a kickback, or you're subject to severe dilution, like the case has been with the SPACs.
But used car salesman.
Yeah, that is also, if you go to a financial advisor or similar, and they are acting more like they want to push that mutual fund on you than actually advising you broadly, then most likely they have a kickback or some kind of incentive which makes it more valuable for them if you buy that fund that they try, or that other investment product that they're trying to push on you.
Investment structure secrets. What should you watch out for?
Same with the fee structure. If you do not understand it, then it's probably something of a red flag. So make sure that any investment that you're doing, that you really understand the structure, what it's all about. Because complexity often comes with some kind of problems or hiding something. So I would recommend you to never invest in something that you do not understand.
Ask the right questions. And then leverage.
Yeah, leverage. We have a episode about margin trading, right?
Very good. I'm gonna link
leverage.
it below.
So leverage means that you can lose more than you invested because you also have a loan component, a debt component. So be very, very careful with any type of leverage finance. Make sure you understand how much can you lose, because it will be more than the portion that you put in, which is bad enough.
It's bad enough.
Yeah.
So if someone says it's no tax.
Also, if there's this new amazing investment structure or product or opportunity, and the argument is that there's no tax, call the tax authorities and check their opinion on it.
Yes.
I'm serious. Because if they claim it, perhaps you should try to have a second opinion and make sure that that's the case. Because typically, there's two things that are certain in life, right? Death and taxes.
You hear that from the business lawyer.
Yeah.
So, but if it's super hyped, I mean, everyone's want to do it.
Yeah. Also, a big red flag, of course. You've seen it again with the SPACs, where suddenly celebrities were, I don't know, endorsing them and God knows what. The hype might not be as good because it's typically trying to push somebody into something new and cool and everybody's doing it, and then reality hits.
Yes, because if everybody else is doing it, you're getting into the feeling.
And that's not a good argument for a good investment.
No. But when do you get the money back?
Also, something to be careful about is if you put the money in, you really understand how and when you can take it back. Because there might be a long lock-in period or something that you did not expect. You might not be able to take it back for 10 years. I mean, wow, that might not be the best for you. So make sure you understand the liquidity. When can you get your monies back?
And if you all bets on one horse?
I'm sure you all heard about diversification, spreading your risk. If you have 10K to invest right now, if you put it all in one basket and the basket drops and the eggs go all over the floor, you're gone. So core in any good investment strategy will be diversification. So make sure you don't put all your eggs in one basket.
That's good. But what are some key ways to avoid ending up in bad investments?
I would say do your due diligence. That's investigating, trying to understand, learn. Don't just trust what other people are promising you, because people promise a lot when they see your money. Get second opinions. Make sure you don't make the decision emotionally, because you're so excited and so hyped and you just shook hands with this cool guy and
celebrate your investment.
Yeah, because it can go fast. I mean, we're all adrenaline junkies, aren't we, when we're in the investments? So that will be two really important aspects. Second opinions, not too emotional. Make sure you understand it, do your research. And the last one would be learn. Be curious, learn. And there are so many great podcasts, YouTube, books, whatever you prefer. Just to name two, we can name Plain Bagel here on YouTube. Wonderful. Very up to date, what's happening, discussing this different opportunities, stocks, short selling, etc. That's one, at least. And we can drop two more below that we can really warmly recommend you both having fun with and learning a lot from.
Yes, that's really good. But all of the examples that we talked about, it's very common, especially if I'm a lot of social media, and I see if you're looking for financial things on YouTube, it always comes up like
The
to invest.
gurus,
Yes,
yeah.
the gurus. Invest this and you never have to worry about money again.
Yeah,
And I mean,
25K, I made 1 million in
Yes.
2 minutes.
yeah, and
right?
it's storytelling. It's great
Yeah.
communication with the videos and the voice and everything. So I understand people really look on these type of
Yeah.
options. But
So if it's too good to be true,
yes, think once again
yeah, forget about it.
so you don't just hand over.
So the links we're putting down below are, I think, more serious. And again,
Yeah.
this is not financial advice. This is not legal advice. This is knowledge sharing. Our opinion. Share if you have some other opinions. If you have a favorite YouTuber or TikToker, share it and we'll
Yes.
happily check it out.
Yes.
But we're still saying if it's too good to be true, stay away.
Yeah, always be critical.
Yeah.
Thank you so much.
Thank
and
you.
I think this knowledge is very valuable. You need to hear it from someone like you, a business lawyer.
Be careful out there.
Be careful. Hold on to your money and be
Yeah.
smart. And if you like our content and think that this is valuable for you, like and subscribe. We're going to keep sharing this, hopefully for the rest of our lives.
Yeah. We're going to be like Warren Buffett then.
Yes, older than him. Thank you so much for watching this video and rock on with your businesses and
Yeah.
investments.
You rock. Bye-bye.
Bye. Hej då.